All right. Hi, everybody. Welcome to our February Money Matters Mastermind. I am going to kick us off here as we go through the January financials, and then I am going to hand the baton over to Bobby Bodner with Breadify, who is going to go over a lot of great information today about taxes and ways that we can increase how much you guys get to keep at the end of each year. So I'm going to go ahead and share my screen and we can get started. All righty. So I'm going to walk us through this little highlight sheet I make to go over some of the stats about the office and the financials from January. So we added 13 new agents in the month of January, which brought our total agent count to 442. And that was with combined 51 appointments for the month of January. We had some great career nights, both in the office via Zoom and at Hondros. So that's super exciting to think of all the new agents joining in the next few months as well. As you're going to see a trend here in the next few data points, our January was down in a lot of categories versus last January. As most of you probably remember, the end of 2020 and ramp up of 2021 were record highs in a lot of those months. So our January 2021 was record high in almost every single category over other Januaries. So as we level back and start seeing more of a normal market here, our year over year numbers are down in some areas. So, sorry, I was just admitting someone. Okay. So our contracts written was down only 3%. We had 285 contracts written in the month of January this year. And that is about 40% of our agent body wrote contracts in January. And that's actually, although the contracts written was down, the same percentage of associates wrote contracts in January 2021 as well. So that's pretty even year over year. In 2021, the number of contracts written was 294. So not super far off, but still down over last year. Listings taken was 141. That's exactly even with the number of listings that we took last January. But the agents in our office who took a listing was down. So we had about 17% of our agent body took a listing last year, and it was only 14%. So although it's the same amount of listings, fewer people took those listings. Alrighty, our total GCI down 1%. That's pretty in line. That's gross commission income. So the commission our agents received that month, it was about 1.4 million, and similar number last year, just down only 1%. So pretty even. Company dollar was 133,302. So that was down about 20% over last year. What company dollar is the 30% that is paid to the brokerage when an agent's uncapped and we receive their commission. So the last 2 years we've been around in the 160s. So this was lower over a couple of years actually in January. And that can mean a couple different things. Agents who were previously contributing company dollar in January capped faster at the back half of 2021. So they are already in cap status. And even if they had closings in January, they received 100% of that, where maybe previously they hadn't capped yet. And so we were still collecting. That's what we've seen, that trend line so far, with 2021 being such a high producing year for so many agents. A lot of people capped faster, which is great. But it shows up in different months where we maybe received more in previous years, depending on how long agents take to cap. Alrighty, profit share was down about 10%. It was 55,000 last January, and it was 50,000 this January, which isn't that far off. It's still the I believe second highest profit share January ever compared to last year. So that's much higher than we have typically seen. So we're still in line with the profit goals we've set for the Market Center this year with those numbers. And our partnerships. So although our profit and profit share was only down a little bit over last January, but our company dollar was down 20%. Our partnerships being up really helped us continue to have a good profit and profit share month. So our title company, we shared the $23,049 in January. That's up 34% over what we shared in the first quarter last year. It was around 17,000 per month. So that is an increase year over year. Our home warranties were about 3,300. That's pretty standard. We're not going to see that very often get over about 5,000 per month. So the 3,300 is around the average that we would receive monthly from warranties sold, although we'd always love to increase that. So anytime anyone has questions about selling home warranties, please let Carrie or I know. And our MSA with Cross Country Mortgage, that's $8,500 every single month. So that is our marketing service agreement with Cross Country for them to be our preferred lender and in-house and work with all of you. We receive $8,500 a month from them. And Greater Metropolitan Management had a great January, as you see, up almost 200% over last January. So I believe it was around 4,000 that we had in total profit with them last January. And with that, we were amortizing buying out more doors at that time. So it was lower, but this almost 14,000 is in line with our budgeted amount of hoping to hit around 15 per month in the profit from Greater Metropolitan Management. All right, and our final couple data points, our total closed units was down 234. So with that, the last 2 years in January have been higher than that. We've seen it in the 260s and 250s. So that is more of a lagging indicator to what was going on at the end of the fourth quarter to what was closing in January. So our contracts written is actually more of the leading indicator with what's going to come in the next few months. So this one just shows less was written likely at the end of the fourth quarter that closed in January. With that, usually these are hand in hand if one's down, the other's down. So total closed volume is the closed purchase price of those 234 closed units. That was also down from last January. So, and last but not least, the average sales price for all that data in the month of January was $192. This has been continually raising over the last, I was going to try and find what the end of last year was. The total went up significantly. We ended last year at 224 as an office for average sale price. So that's the highest it's ever been. We've typically been around like 190 as an average last few years. So for this to be just the January average is in line with our history. But with prices continuing to rise last year, we saw as a whole for 2021, the average was 224. So that's great. Great marketing for those of you taking listings and talking about your own like data and average sales prices. All right. I am going to stop share and open it up to any questions anyone has about some of those specific points, whether it's, you know, listings or closed business or our vendors. If anyone has any questions about January's data. All right. Well, Bobby, if you are with us, I think that we're ready to pass it on over to you.
All right. Fantastic. Can everyone hear me?
Mm-hmm.
Awesome. All right. I'm going to try to not bore you guys too much. I am going to share my screen because I put a little something together because I think a lot of what I'm going to talk about is easy to understand visually.
Let me give you share screen rights here. Hold on. You're somehow the host. Sorry.
No problem.
Okay. You should have it now.
Yep. Okay. All right. Can you guys see this?
Yep.
All right. Let me just get this bigger. All right. So, like I said, I'm going to try not to bore you. I mean, I'm talking about some, taxes, bookkeeping, accounting, some of the most boring stuff on earth. So I always like to open it up. If you have any questions or if there's anything that I'm saying that you either want me to go back and explain a different way, please just let me know. Feel free to chime in at any time. That's me with short hair. But I am the founder of Breadify Financial, where we help entrepreneurs save thousands of dollars on taxes by applying, vastly underutilized but completely legal loopholes in the Internal Revenue Code. Basically, what that means is, like, these books over here are the Internal Revenue Code, and every single year they're sent to us, and this is what governs what is taxed. And the bottom line is just about everything is taxed. And that's about the first 50 pages of those books. But the remaining, 3,500 pages is out how to get out of that tax. So a lot of what I'm going to try to do is just educate you on the basics of what are some of those things that you guys can do as entrepreneurs, as business owners, because that's what you are at Keller Williams, 1099 business owners, to take advantage of those, the tax code. I also like to remind people that the easiest way to make another $10,000 this year is just to not give it to the government in taxes. A lot of if you go on YouTube or TikTok or social media of any kind, there's always creative ways to go flip, products you have on eBay, or go sell certain things, or go get a side hustle, whatever it is. And that's all great, but it's really not about what you make. It's about what you keep at the end of the day. So that's kind of just something to keep in mind. Easiest way to make 10,000 is just don't give it to the government in taxes. Before we get into any education, I always like to just go over important upcoming tax deadlines. I know this one right here recently passed, but I think it's such an important one for anyone who is a business owner, because the penalties can be very hefty. So this right here, this 1099 NEC deadline, which was on the last day of January 31st. I feel like a lot of people don't really understand it, what it means, who requires a 1099, who doesn't. A lot of people are familiar with receiving 1099s, but a lot of people are not familiar with sending out 1099s to people they have paid for business goods or for business services throughout the year. So I'm going to touch on this a little bit later, but I just think this is a really important deadline. The last day of January is the 1099 NEC deadline. It needs to be sent to both the payee, the person that you paid, as well as the IRS. The last day of January is also for 2021 payroll tax reports for the fourth quarter and year end of 2021. February, where we are currently, is fantastic. It's a great month for tax accountants and for business owners because it's a catch-up month. There's no really big important tax deadlines in February, and it's a great time to either go enjoy life, family, whatever it is, or you could use your time wisely and try to catch up on the things that everyone hates doing, such as bookkeeping, which is so important to be good, to be a knowledgeable business owner, to be good at taxes. It's really just, it's the secret sauce to being able to be good at the game of taxes, is solid, up-to-date bookkeeping. All right, March and April are both huge months for tax deadlines, and for March, it's March 15th. March 15th is the SCorp 1120S tax return deadline. So anyone who has either an LLC taxed as an S corporation or a corporation, SCorp taxed as an S corporation, your tax return is due March 15th, or you can extend. And if you extend, you get an automatic 6-month extension. And you can do that by filing Form 7004. Also for partnerships. So if you have an LLC and you're in business with someone else, so you don't own 100% of that LLC, then there is a 1065 partnership tax return due on March 15th. And then you can also extend 6-month extension with the same Form 7004. March 15th is also the deadline to fund SEP IRAs and solo 401ks if you are an LLC taxed as a partnership or a multi-member LLC, an S corporation, or if you extend, then it gets pushed to that future deadline. So the important thing to remember here is if you are an S corporation, if you are in a multi-member LLC, if you require an 1120S or a 1065, that deadline is March 15th, or you can extend it for 6 months to September 15th if you file Form 7004. But something needs to be done on March 15th. All right, April. Everyone knows tax. People think of tax time April 15th. This year it's actually April 18th because it falls on the weekend, holidays and whatnot. So April 18th is the date this year, and it is for individual 2021 1040 tax returns due. So you can extend that with Form 4868. So if you're not ready to file your taxes on April 15th, not a problem. File Form 4868. You get an automatic 6-month extension, which then takes you out to October 15th. C Corps, there's no reason really that any of you should be C Corps, but if you are a C Corp or if you own a C Corp or for whatever reason, that tax return is due April 18th, same date, but you can extend it, Form 7004. And then the estate and trust, the 1041 tax return also due April 18th, 7004. You can extend. Like I said, I know this is very boring stuff, but it's important just to keep these dates in mind. March 15th, April 18th, things need to be done by those dates. So I would just mark them on your calendar. All right, so here's the last important deadline. Same day, still April 18th. A lot of people don't they forget that when you're a business owner, April 18th or the tax day, normally April 15th, there are 2 payments that are actually due. You're paying your 2021 taxes for however much you owe. If you owe any more in 2021, it's due April 18th, but you're also paying the first quarter of 2022. So and that's an estimated tax payment. So any money that you've made between January 1st and the end of March, you're supposed to send the IRS an estimated payment based off your previous year's liability on that date. So you're actually paying 2021 taxes and the first quarter of 2022 on the same day. A lot of people forget that, and then they end up not sending in their first quarter estimated tax payment for this year. So that's something else to keep in mind. If you have an HSA, your contribution for 2021 needs to be made by the same date, April 18th. Same thing for traditional Roth Coverdale IRAs. If you want to make a 2021 contribution, needs to be done by April 18th, even if you extend. Doesn't matter. You still need to do it by this date. And then lastly, the deadline to fund the 2021 SEP IRA or solo 401k if you're a sole proprietor, unless you extend. So sole proprietors are treated differently because that's a 1040 and your Schedule C goes on your 1040. Then if you're an SCorp and you have an additional business tax return, these are just high level things, but the important things to keep in mind is April 15th or April 18th and March 15th. Mark them on your calendar. Make sure you get in touch with your tax professional before then and just go over these information. But this is high level things you want to keep in mind. Does anyone have any questions on any of those tax deadlines, or should I keep going? Yep. Allison, I saw that you raised your hand. Yeah.
Do you have to file, do you have to pay quarterly in advance to the IRS? So, I know you get penalized if you don't when you live in Cleveland Heights, the worst city in the world for taxes.
Well, I don't know about that because I was in Los Angeles and California is way worse for taxes. Okay. But to answer your question, the way this works here is that the tax system is a pay-as-you-go system. So if you compare what it is like receiving 1099 income to receiving W-2 income, right? When you receive a W-2, if you have a normal 9-to-5 job, you get paid a paycheck, and then out of that paycheck, money goes straight to the government. So every time you get paid, the IRS gets paid. And that's what the IRS wants, because they don't trust us as business owners to keep enough money on hand to then pay the IRS. So we really live in a pay-as-you-go system. But the problem when you're 1099 is no one is withholding taxes from your paycheck. Okay. So the answer is yes. Every single time you get paid, you're supposed to send in money to the IRS. But the way they do it as a self-employed individual is you do it based off of quarterly estimated tax payments. So the way we do pay as you go is we look at how much money we made in the previous quarter and we send in, here's how much we're expected to owe for that quarter to the IRS. So that first estimated tax payment for 2022 is due on April 18th this year. Does that make sense? Okay. Does anyone have any other questions? All right. All right, cool.
If you don't pay those quarterly along the way, what happens?
So nothing happens per se. You do get hit with a little penalty, and it's minor, right? It might be like 1 to 2% of what you owe, but there is additional penalty. So if you're not going to do the pay-as-you-go system, some people are like, listen, I can put my money to use better than giving it to the government once a quarter. And if I'm going to put it back in my business, I can make more money with my own money. And if you're going to weigh, maybe you're like, I can get 5% rate of return if I keep the money in my business versus giving it to the IRS and having to pay a 2% penalty, then you can say, fine. Like, then you'll just pay when you file your return in, either April 18th, or if you extend October. So if you can do that, and you can just pay with the return, but you will be hit with some minor underpayment of penalty. So it's like, 1 to 2% depending on how much you owe. So the more you owe, the higher that penalty is going to be, because that percentage is based on what you owe. So my job as a tax advisor is to help you pay as little in taxes as possible. So I always advise people to send in those estimated payments. And then if you end up owing more, that's fine. But there's what's called a safe harbor clause, and they're basing these estimated tax payments off your previous year's tax liability. So if you owed, $10,000 in taxes last year, as long as you pay at least what you owed last year, and if you make a certain amount, it's 110%. But that's what, like, so if you go and file your tax return, your tax advisor should give you 4 different payment vouchers, the 1040 ES payment vouchers, saying, hey, send this much money into the state, this much money in federally each quarter. And you'll know exactly how much to pay. And as long as you do that, even if you have a much better year this year, you're not going to get hit with the underpayment of penalty because you hit the safe harbor rules. So they're basing these estimates off last year's tax liability, which is why it's an estimated payment. They're not saying, tell me exactly what you owe. They're saying, tell me what you think you're going to owe. And if you end up making more, you'll owe us more when you file your return. So did that answer your question? I hope so.
Yes. Worst case, small penalty, correct?
Worst case, small penalty. A lot of people do this. A lot of people we work with, they're just like, either they don't want to do they either forget to do it, they don't want to do it, whatever. It's up to you as the taxpayer, whether you want to send in this money or not. And if you're like, I'm okay getting hit with a minor underpayment of penalty, then go right ahead. That's okay. But I advise send it in. Yeah.
Thank you.
I had a question.
Sure.
So I did pay all my quarterly payments,
Sure.
but I combined Q2 and Q3 together with one payment. Is that okay, or will I get penalized for doing that?
It depends. You should be fine. I mean, you're giving money to the IRS. You're doing better than a lot of people anyways by just giving them money, and you're doing your best to get it in on time. You shouldn't be hit with any penalties. The one times that you might be hit with penalty is, say you don't make any estimated tax payments throughout the year, and then Q4 payment rolls around. You're like, oh, I might as well just send in everything I owe. The IRS is then going to be like, well, did you just make all of your money in the last month of the year, or were you not paying us, right? That's what starts to raise questions, is if you're doing it in just one lump sum, and that's when you might get hit with a penalty. But you could easily tell the IRS, hey, I'm an entrepreneur, I didn't have any sales that quarter or whatever it was, and that's why I didn't make any money. There are ways to, if they did come after you saying, hey, we're going to hit you with an underpayment of penalty, which wouldn't be major anyways. But you should be fine by combining those. I always you always want to send it in once a quarter, because you do know what the amounts are prior to the year, right? Because you're basing it off the previous year. So it's not like you actually have to look at how much you made. If you made way more this quarter, you might want to send in a little more, right? To do it that way. But I wouldn't worry about it, what you did.
Okay, thank you.
Yep. All right, are we good here? I'm going to move on to the 1099 NECs, because I see this messed up quite frequently, and I want to try to clear up as many of these questions as possible, because I just think it's so important, and this is something you're going to have to do every year as a business owner. All right, so what you need to know: the 1099 NEC. The 1099 NEC stands for non-employee compensation, and it replaced box 7 on the 1099 MISC, the miscellaneous. So the 1099 MIS. That was the form used up until 2020. Now, now box 7 is where you used to report any business services that you paid for your business throughout the tax year. And if it was over $600, you had to send them a 1099 MIS prior to 2020. That form was now changed, and they made a new form called the 1099 NEC. And that is what we as business owners now use to report non-employee compensation. So the rule is still $600. If you pay someone to help you with marketing or advertising, or to help you with really any business service, you are going to have to send them a 1099 NEC with the total amount on that form. So a lot of people, especially real estate agents and people at Keller Williams, are familiar with receiving the 1099 that they get. So it shows the amount of money you were paid, but you also need to be the payer. So so when you are the payer, you need to report the 1099, and you're going to send one to the recipient, the person that you paid, and another one to the IRS. So essentially what you're doing here is you're saying, hey, IRS, I want to write off this expense, right? Like if I paid someone $1,000 to help me build a website, I want to write off that expense on my business's tax return. And the IRS says, that's fine. You can do that because that's an ordinary necessary business expense. But in order to do that, we want you to tell us who you paid. So the IRS wants to know, who did you pay that $1,000 to? And then they're going to go after that person and make sure that they put that $1,000 as income on their tax return. So it's the same thing with Keller Williams, right? Like the money that they're paying you, they're going to lower that on their tax return. And then you guys are going to pick it up on your tax return. So you're just playing the opposite side of the 1099. And this is very important because the penalties can be very steep for not sending these out. So if you have that person who's helping you in your business, the website graphic designer, and you write off the expense, but you don't send them a 1099, those penalties can be very steep. And that's what we're going to touch on. All right. We're going to talk about exceptions real quick because it's like, okay, well, who needs a 1099 and what are the rules with that? Basically anyone providing services for your business needs a 1099, but there are exceptions, and these exceptions include paying for physical goods or products. So we're not talking about if you're buying any physical products from this vendor, that's not a 1099. You don't need a 1099 them for that. If you are paying a C corporation or an S corporation, you don't need a 1099 them. And then you might be like, well, how do I know if someone's a C corp or an S corp? You're a C corp if they're a huge company, right? If they have an Inc. at the end of their name, I mean, you'll know whether they're a big corporation. But an S corp, that could be tricky, right? You could be an LLC taxed as an S corp. You don't know whether they're an S corp or not. You don't know whether the person who provided services to you is operating under an S corp. So the only way to know this is to send them a W-9. So the W-9 is the form that you send to the contractor. They complete it. And then based off the information on that W-9, you'll know whether you need to send them a 1099 or not. So we're going to touch on that more. And the caveat to that rule is if you're paying for medical services or an attorney, regardless of how that attorney is taxed, even if that attorney is set up as a C corporation or a professional corporation, you still need to 1099 them. And the only logic behind this is that the IRS does not trust attorneys. That's just, it's up to you. I don't know why the IRS stipulated that, but if you pay an attorney, regardless of how they are taxed, you need to 1099 your attorney. All right. And this is the most common thing that I see messed up because it's gotten very confusing over the years with all of the different ways to pay people. But when you're paying for services, so if you pay that website graphic designer via credit card, you don't need a 1099 them. If you pay them via debit card, you don't need a 1099 them. If you pay them via third-party payment processor, such as Stripe, like they use Stripe and you swipe your credit card, don't need a 1099 them. If you go to Upwork or Fiverr or any of these third-party services and you're paying for the contractor through that service, you don't need a 1099 them. And then PayPal, this is where it gets tricky because if there's two different options, I don't know if any of you have paid anyone on PayPal before, but the way it works is when you pay someone on PayPal, they give you an option. They say, is this a friend or a family? Or is this for goods and services? A lot of people choose the friends and family. Why? Because then you don't need to pay the fee, right? The payment processor fee of 2% or whatever it is. And when you do it that way, when you pay friends and family, you still need to 1099 them. Because essentially you're telling PayPal, hey, I'm not paying for goods and services because I'm told you it's friends and family. So then they're not going to be responsible for the 1099 reporting. So if you use PayPal and you want to avoid the fee, you are now responsible for the 1099 reporting. That being said, if you use the business and the goods and services and they take a fee out of that payment, you don't need a 1099 them. PayPal will handle it. And the same works for Venmo, right? A lot of people pay people on Venmo. If you're paying someone on Venmo and there's no fee taken out of it, you are responsible for the 1099 reporting. So cash, check, those sorts of things, ACH, any money you're out of your pocket into that contractor's pocket, you need to 1099 them if it's $600 or more. So hopefully that made sense and that cleared up a few of the things. The main thing to remember is if you're using any of these payment processors such as PayPal or Venmo and there is no fee taken out of it, there's a good to fair chance you're going to need a 1099 then. If there is a fee taken out of it, then there's a good chance you won't need a 1099 then. All right. And you might be like, well, why does any of this matter? Well, it's because the penalties are pretty steep. And the IRS clearly, I mean, they take it pretty seriously. If you just look at these numbers, the penalties vary from $50 to $270 per form. So if you needed to send out 10 1099s and you didn't send out any of them, then it's $50 to $270 times 10 per form. So depending on how long past the deadline you are. And then the maximum penalty is astronomical, $556,000. So, you know, they'll cap it at $556,000. But if you get hit with those kind of fees, like, especially as a small business owner, that's a lot of damage. The other thing to remember is if you intentionally disregard the 1099. So if you know about this and you still don't do it because you're like, whatever, I don't care, or I don't want to do it, and you intentionally disregard, there is a minimum penalty of $550 per form. So it gets very steep very quickly. And that's why I want to just clear this up as much as possible. And the last thing I'm going to go over here is just some best practices. So what should you do so that you don't fall into this trap going forward? That W-9 that I mentioned, this is what you need in order to complete a 1099. So maybe at the end of the year, this happens all the time. People are like, I know I need to send out these 1099s, but I don't have the information. I don't know the guy's address. I don't know how much I paid them. I don't know what their social security or the EIN number is. Like, there's information that you need. All of this information, except for how much you paid them, is on the W-9, which is why best practices, send the IRS form W-9. You can print it out online. They're available. What we do for our Breadify members, we actually create a custom link for each member. And then they send that link. They can text it, email it, however they want to get it to their contractor. They click it, fill it out online, and it automatically gets sent to us, their tax team, so that they don't need to worry about anything. And then at the end of the year, we have all the information needed to file the 1099s on their behalf. So the rule here is send that W-9 prior to payment, before you give them any money. Even if you're like, oh, I'm only going to pay them $100. I'm going to pay them $100, but I'm going to pay them via cash or check. So they are in that realm of, I do need to send them a 1099, but they're under the limit. Still send it, because who knows, you might go back to them later in the year and say, hey, I need to pay an extra $400 to do something else. And if you're paying them $100, $200, $500, and now they're over the threshold, all right, you needed a W-9 from the start. Like, you needed one from the beginning. So the best practice is, regardless of amount paid, send them a W-9 prior to you giving payment. So you come to the agreement, you say, here's the goods or here's the service you're going to provide for me. Here's the amount I'm going to pay you. Before I pay you any money, I require a W-9. And some contractors, because they like doing things under the table, I don't want to deal with that. And if they make,
I couldn't be any from no 12 to 8 at an event. That's just weird.
Oh, all right. Okay. So the other thing that you can do is just blame it on your accountant, blame it on your tax team or your guy. Like, if some people will get weird about it, if you work with a contractor and like, well, you know, why do you need this? Or why am I giving you my SSN or my EIN or whatever? Say, hey, like, I don't know. My accountant says I got to do it. Blame it on your accountant, blame it on your team of professionals, whatever you want to do, but make sure you get that W-9 each year. And that was another point here, is that you're going to want to update this every year, not because the social security number is going to change or things like that, but the tax classification could change, right? Like, you know, maybe they're a sole proprietor right now, and then they talk to a tax professional and they're like, hey, you should be taxed as an SCorp, and now they're an SCorp. Okay, well, now they're taxed as an SCorp, and you don't need to send them a 1099 anymore, but you wouldn't know that unless you got a new W-9 from them. So the W-9 is going to tell you that information. And the other thing that changes is the address. Maybe someone moved. So the address that you're going to actually be sending the mail copy of the 1099 to, if that's their old address, then they're never going to receive it. So you want to stay up to date with these 1099s, get a new one once a year, and just keep it on file. So it's an internal document. It doesn't go anywhere, but you use it to complete the 1099, which then goes to the recipient and to the IRS. And if all of this is just like way too much stuff, another option is to use a payroll service provider. So we recommend Gusto. Gusto works fantastic. even if you're just paying contractors and you don't have any W-2 employees, they take the whole W-9, 1099 tax reporting out of it. So what happens is you would go to your contractor and you would send them an onboarding link. They would get onboarded on. So they would put in their own information, you wouldn't have any of it. It would all be in the system. You would pay them via direct deposit. So if you say, I'll pay you $500 for whatever, it would be $500 ACH direct deposited into your contractor's bank account. And then at the end of the year, Gusto will send out that 1099 and directly to the contractor. So you won't have to worry about anything. So that's another option, is stop using PayPal friends and family, stop paying cash or check or whatever it is, and use an actual payroll provider. It makes you look more legit. It looks very professional when you're sending, when you're doing this whole onboarding thing and it's direct deposit into their account. And it also removes the tax reporting off your plate. So that's another option if you just want to completely disregard this. Let's see, how am I doing on, okay. All right, does anyone have any questions on W-9, 1099, this sort of area? No? Okay, I'll make one last note about this, which is people ask a lot about what do you do if someone's outside the United States? If you pay someone in India to help you with your website, like would you 1099 them? The answer is no, you cannot 1099 someone outside the United States, but there is another form that you're supposed to get on file. Instead of a W-9, it's called a W-8 BEN, B-E-N. So it's a W-8 instead of a W-9. And what you're supposed to do is send that to the contractor, have them complete it, and then you keep that document internally. If you ever got questioned by the IRS or for whatever reason down the road, they would want to see that W-8 on file for the money that you paid to the international contractor. All right. So we're going to move from the 1099 stuff, and I'm going to try to touch on as much additional things as I can. I think I got about 20 minutes, I believe. Is that right? 20 minutes? Okay.
Yeah, that's about right. But if people have questions, yeah.
Cool. So, and also if I'm just going to talk and I'm going to go over this stuff, if you guys have any questions, just chime in, I'll stop and I'll answer your questions, because I feel like the questions are more important than just broad level information. So, changing your mindset. I like to really emphasize this because people have this thing about hatred of taxes and government, and I get that. But it's the price that you pay to live in a civilized society. And you can question all day long about how they are using your tax dollars. I don't agree with how they're using the tax dollars either. But the fact that you are going to owe some money in taxes is just the cost of living in the United States and in a capitalist society. So if you change your mind about what taxes are, from you just paying the government for no reason to being a series of incentives, then it switches what this is, because you think about it as, if I do what the government wants, I will pay less money in tax. And that's all the tax code is. That entire book, these books over here, is basically saying the government figured out a long time ago that if they give you a set of rules to lower your taxes, then you will do those things to pay less money in taxes. So if you do what the government wants, you will pay less money in tax. And then the question becomes, well, what do they want? So, all right, I don't know. I think this is a little bit out of order, but the SCorp thing. Another thing to keep in mind is people are like, when do I become an SCorp? The common rule of thumb to keep in mind is that 40,000 mark. If you are making more than $40,000 net in a tax year, in 2021, in 2022, whatever, you should be taxed as an SCorp. Doctors, lawyers, dentists, attorney, any ordinary income you are making, it doesn't matter what you are doing to make your ordinary income. If you are making more than $40,000 net, you should be taxed as an SCorp. So that's just a number to keep in mind, that 40,000 mark. All right, back to what I was saying. What does the government want? The government wants to stimulate the economy, provide jobs, affordable housing, renewable energy. The bottom line is, be an entrepreneur and an investor. And you guys as real estate professionals, I mean, I'm not even lying to you. You guys have the best tax setup around. I don't qualify as a tax or as a real estate professional. The real estate professional classification is fantastic. So what you guys have is the ability to hit all three of these boxes. You are an entrepreneur. Whether you call yourself an entrepreneur or not, you are receiving 1099 business income, and you are a business owner. You are an entrepreneur. So now you're in the game. So you hit checkbox number one. Number two is an investor. So you can be an investor in stocks, bonds, mutual funds, like traditional stuff like that, or you can invest in more alternative assets such as real estate or crypto or, basically anything. You can invest, you can make gold, silver, precious metals, whatever. But being an investor, great tax benefits. That's why there are long-term capital gains, right? The long-term capital gains rates are lower than ordinary tax rates. Why? Because they are incentivizing you to make some money as an investor. And then lastly, you guys as real estate professionals, it's a box that you check on your tax return. And you need to make sure you are doing this, especially if you own rental real estate. And I know a lot of you do. A lot of you, you're in the space, you're out there selling homes, and you also know what the good markets are. So you buy an investment property that you rent out to tenants or for whatever reason. If you own rental real estate, you need to make sure that a real estate professional checks box is marked on your tax return. It will save you significant money, and it allows you to offset those losses. Because a lot of the times when you invest in real estate, on paper, it'll show a loss. So from a tax perspective, you're showing that you made no money. That's not actually true, right? Your cash flow from the tenant or whoever is paying you every single month. Money is coming into your pocket every single month from rent. But on a tax return, it's showing that you lost money because of depreciation and all the expenses that you can offset against that income. What's great about being a real estate professional is that those losses on that rental property can now be used to offset your ordinary income from your 1099s, from anything else you got going on in your life. And I always joke around about this, but it's true. If I ever created a tax or like how to save the most money on taxes, like dating website, it would be pairing up real estate professionals with business owners. If you have a successful business owner with a husband or wife that is a real estate professional, because they're either an agent or they're property management or they're doing something all day long in real estate, it works for both of you. So if you're on the same tax return, even if only one of you is a real estate professional, you get the real estate professional classification for both of you on the tax return. So that if you have a bunch of rental properties, all of those losses from the rental property can be used to offset the business owner's income from his business. So combining a successful business owner with a real estate professional and having rental properties with significant losses is like the holy grail of tax planning. So that's just something to keep in mind here, because that is like, I tried getting my wife to become a real estate professional and she wouldn't do it. So I don't get this benefit, but you guys can all have this benefit and take advantage of it with real estate and with rental properties and being a real estate professional. All right, moving on. This right here is just kind of a typical entity progression. And it's what we see most common. And starting out as a business owner, you start out, if you do absolutely nothing and you take zero precautions and you're just like, listen, I'm going to go start selling lemonade at the end of the block. And I bought the lemons and the sugar and the water and the cups and all that stuff, and I'm selling it and someone gives me money. I'm in business, right? I just sold my first cup of lemonade. I'm currently in business. I didn't set up an entity. I don't have an LLC. I don't have any partners. I didn't do anything. I just started selling lemonade. By default, you are a sole proprietor. You are a sole proprietor. You have zero asset protection, which means if you got sued because someone claimed that they got sick from your lemonade that you sold them, then they could sue you personally, which means they can go after your personal bank account, your home, your car, any assets that you own. If a creditor would be able to come after you personally. So that's where most people start, and that's fine if you're entering a low liability business and you just want to get started. I just go out there, start selling cups, get some proof of concept and see what happens. The next step is, all right, now I want to take myself more seriously. I want to call myself something other than, Bobby Bodner, lemonade stand, whatever. And I want to set up an entity. So the next step is typically an LLC. So you set up an LLC that provides you the asset protection. One thing to keep in mind, and I hear this constantly, LLCs do not save money on taxes. I cannot emphasize that enough. LLCs do not do anything for you from a tax perspective. The only reason you have one is for asset protection. So if that same example happened when I sold my lemonade and then someone sued me because they got sick from my lemonade, if that happened, they could only sue the assets of my business, which means they could only sue my business checking account, my business auto if my car had its own business, or my business equipment, or whatever it is in my business, they can sue. They cannot access my personal residence. They cannot access my personal checking account. And this is very important for real estate agents, because if you're taking clients in cars and you're driving them around because they're in your car, even if you got into an accident in your car, but a client's back there and you don't have an LLC, you're operating as a sole proprietor, I mean, they could sue you for everything that you've got. So LLCs and entities are fantastic and they're a necessary part of business, but they don't do anything from a tax perspective. They are for asset protection. And that's why attorneys are the ones that work with LLCs and set up LLCs, because they're not for tax purposes. They're for asset protection. All right. And then you might be like, okay, well then what's the deal with this SCorp? Well, the SCorp is not an entity. The SCorp is a tax election. So you can't just go to your state and say, hey, I want to set up an SCorp. They're going to be like, okay, do you want an LLC or do you want a corporation? Because those are your two options. You're either going to set up an LLC or a corporation, and then you're going to elect to have that entity taxed as an SCorp. So most of the time, I would recommend going to do an LLC. The only time I would recommend setting up a corporation first and then going to an S corporation is if you want to be an S corporation right from the start. So you're going sole proprietor, you're skipping this middle step. You're saying, I'm not going to do the LLC. I'm going to go sole prop. I'm going to jump right to the S corp because I'm going to make a bunch of money immediately. And I'm going to just be a C corp right into S corp. You can do it that way, skip the middle step, but this is a typical entity progression, especially in the state of Ohio, which is where I'm originally from. And I know a lot of you guys are based. So in Ohio, it's $99, one-time fee. There's no annual maintenance. There's nothing. So that's a lot different than a lot of other states. Example, California, where you pay $800 every year just for the right to have an LLC in that state. Every year, even if you made $0, you're paying them at least $800. So that's California. But in Ohio, get the LLC, set it up, $99. There's no annual maintenance, or there's no annual requirements or annual statements or anything like that. The S corp is where you're getting both the LLC, the asset protection from the LLC. So you see the solid line plus the S corp tax treatment. So S corp is a tax treatment. S corp is not an entity. Any questions on that? Does that make sense to everyone? All right, I'm going to take silence as you're still awake, but it all made sense. All right. If you need an S corp, all right, so here's some things to consider for an S corp. People, because the other common question I get is, well, if S corps are so great, why don't I just do it now? Why don't I just start as an S corp right from the beginning? And that's fine. You could do it that way. You could be an S corp from day one, but there are costs that come with being an S corp. So S corps are fantastic and they ultimately will save you thousands of dollars every year on taxes. But the question is, do I do it now or do I wait? And that cutoff, remember I mentioned $40,000 is the number to keep in mind. If you're netting more than $40,000 in a year, that's when you're like, okay, I need to be an S corp. If you're under that threshold, that's when you might be like, maybe I'll hold off for a little bit. And the reason for that is like, let's just look at these costs. There's going to be an additional payroll cost. When you are an S corp, you need to start taking a W-2 salary out of your entity. So you need payroll. So you need to use a payroll provider. You need to take quarterly payroll reports into the 941s. So there's more maintenance that comes with being an S corp. There's an additional tax return. So before, if you're just making your money as an individual and you're just making it as a sole proprietor, whatever, or a single member LLC even, it's all going on to your Schedule C, which is a part of your 1040. So there's no additional tax return. So if you're going to a tax preparer, or if you're using TurboTax, or if you're doing it yourself, the second you go to S corp, you're out of the game of I'm doing this all by myself. You're going to end up jacking it up if you're trying to be an S corp by yourself. I've seen it done too many times. People are like, yeah, that's great. Just get me set up and then I'm going to take it. It's like handing a loaded gun to a child. Like they have no idea. It's in a recipe for disaster. So if you are going to be an S corp, there's going to be an additional tax return called the 1120S. And then that is probably when you're going to need to step up your game and get a professional to start helping you file those returns. There's additional entity, setup fees, like I mentioned, depending on what state you're in. Ohio, it's $99 one time. So super easy there, but you're going to have to set up an entity. You can't be an individual, like a sole proprietor, taxed as an S corp. You need an entity. So you need to either have an LLC or a corporation to be an S corp. You can't just be like, hey, I'm a sole proprietor. I don't have an entity. I want to be taxed as an S corp. It doesn't work like that. Company maintenance and bookkeeping. So like I said, bookkeeping is important. If you want to be good at taxes, bookkeeping is like ground level. You got to be good at bookkeeping. So bookkeeping and staying up to date on your books is foundational as a business owner, but it's imperative. Like it's literally not an option anymore once you're an S-corp, because once a quarter, you're going to have to take a salary. Once a quarter, you need to look at how much money I made this last quarter, and I need to take a W-2 salary out of my S-corp. And unless you know how much money you made, you're not going to know how much a reasonable salary is. And that's what the IRS says. You need to take a reasonable salary out of your S-corp. A lot of business owners want to take less W-2. Why do you want to take less W-2? Because then you pay less self-employment tax. Well, when you take less self-employment tax, you get more audited. So there's a fine, there's a limit, there's a sweet spot here. And that's what a tax professional and a tax advisor helps you find, which is you're making X amount of dollars. I need to take X amount of dollars as a reasonable salary. And I want to minimize it as much as possible, but I want to make it high enough where the IRS isn't going to come ask and say, hey, what's going on here, and get audited, right? So there's a sweet spot that you need to hone in on. And the only way to do that is to be up to date with your books. So that being said, these are the reasons why you don't just become an S-corp from day one. Because if you're a business owner and you already have so much stuff going on and you're trying to get your business running and your marketing and you get your first client and figure out how to collect money and all that stuff, you don't need to add on all of this stuff right off the bat. You can graduate into this. And that's why that 40,000 mark is just a common rule of thumb to keep in mind. So hopefully that made sense. And that answered the question as why you don't do it immediately, or you could, but then there's all these costs with it. But that's the kind of a high level overview of the S-corp, when you should be one, and ultimately what the pros and cons of having one is. Does anyone have any questions on the S-corp? All right. Oh,
I
you got a
do.
question. Cool.
Sure
What do you-
do. So if you create an S-corp, do you then file your taxes differently? You file just a business tax? Or do you have to then also file, like, with my husband, we file a joint return?
Right. Good question. So the way it works is it's not removing the 1040. So the 1040, your individual return, is going to remain something that you file forever for the rest of your life, most likely, right? The government wants their money. It's an additional tax return. So you are going to be filing an 1120S. Remember, I gave those deadlines at the beginning where I said, if you're an S-corp, March 15th, and then an individual, April 15th or 18th, whatever it is. Now there's an additional return. So you're going to be filing on March 15th or extending, and then you are going to be also filing your personal return. So the way it works is an S-corp is a pass-through entity. The same thing with an LLC, right? They pass through. It's either a 1065, an 1120S, these are all pass-through entities. So your S-corp doesn't actually pay any taxes. Your S-corp, let's say you netted $100,000. I actually think I have, yeah, right here. All right. So if we look at this, and if you net this right here is an apples to apples comparison of if you made $100,000 net as a sole proprietor versus $100,000 net as an S-corp, showing you're saving around $10,000 every year with nothing different than changing the way you're taxed. But what this is doing here is it's comparing these savings. And ultimately what you want to remember here is the S-corp is saving significant money on self-employment tax, and it's doing it by having most of this money pass through as a K1. And if you're familiar with what a K1 is, the S-corp is not going to pay money on taxes. So this $100,000 net your S-corp isn't paying any money on taxes, but it is filing a return. And then that money, that profit, is flowing through onto your individual return. So you'll pick up the K1 and the W-2 on your individual return. So it's not removing the 1040, your individual return, it's adding on an additional tax return. And that's what's happening. Does that make sense? Kind of, okay. Any other questions on S-corp or payroll or W-2, K1, any of this stuff? All right. How much time do we got? 5 minutes. All right. I'll if there are any questions on anything that I've covered or any other questions that you want or topics you want to go over, I'll answer them for the next 5 minutes. If not, I think I've got a little bit of information on business write-offs and expenses and what is an expense, what isn't. I don't know. I'm not going to be able to cover most of that in 5 minutes, but I'm happy to just keep going on that. So whatever you guys want.
Hey, this is Chris. I'm just curious, as far as I have an LLC now, but I made, enough in that range where, I've only been in real estate about 1.5 years, almost 2 years now. but to switch over to the SCorp, what's the easiest way to do that?
Great question.
Like where to go?
Yeah, so great question. The process is filing form 2553. So you're going to want to write that down. IRS form 2553 is the SCorp election form. And essentially what you're going to tell the IRS is if you already have the LLC, you're good. You're going to say, hey, I want to take my LLC and I want to tax it as an SCorp. The good news is you can backdate that SCorp election to the beginning of the tax year. So right now we're in February, we're like mid-February. So technically, this might get a little confusing, but I'm gonna try my best to explain this. If January 1st, 2022, I was just a sole proprietor. I don't have an entity, and I made $10,000 in the month of January, right? And then you come to me and you're like, oh my God, I wanna be an SCorp. I'm making $10,000 a month. Like I definitely need to be an SCorp. I'd be like, okay, great. Let's get you an LLC. Let's have that LLC taxed as an SCorp, which you do by filing form 2553. So that's the form. But the bad news is you made $10,000 in January prior to an LLC being in existence and prior to an SCorp election. Therefore, that $10,000 is still going to be taxed as a sole proprietor. Even though we are going to have an SCorp in the tax year, you can't backdate it to prior to an LLC start date. So if that made any sense, let's use that same example, but 1/1/22, I have an LLC. So now I have an entity. I didn't tax it as an SCorp. I'm just an LLC, just like you were saying. So I'm an LLC, but I made $10,000 in January, $10,000 in February, and now we're like, okay, I want to be an SCorp. We can backdate that SCorp election to 1/1/22 because you had an LLC. So LLCs, I like to call them SCorp insurance, because basically you can set one up. If you don't make enough money to be taxed as an SCorp, just let it go and you can do this next year and everything will flow through onto your individual return. But if you do end up killing it and you have a great year, you can file a retroactive SCorp election to the start of the tax year, 1/1/22. So if you took away anything from that, it is if you don't know whether you should be an SCorp or not, and you're in Ohio where LLC fees are very low, what you can do is set up an LLC now if you don't already have one. Wait until the end of the year, or you can go to your tax professional in April, May, June, July, around there, right? Halfway through the year, you're like, hey, I ended up killing it. I made way too much money this year. I need to be an SCorp. They can retroactively elect to have that entity taxed as an SCorp 1/1/22. So you can do that. So, and that's something to keep in mind. It's called SCorp insurance, but you can only do that if you have an active LLC. If you are operating as a sole proprietor and then you come to me in October of this year saying, hey, I killed it, I need to be an SCorp, there's nothing I can do for you. I cannot backdate your SCorp election to the beginning of the year if you do not have an LLC in existence. So that is something to keep in mind. But to answer your—
Okay, great. Thank you.
Yeah, to answer your question, you want to do form 2553. The other thing to keep in mind is if you're going to do this retroactive SCorp election, you need to file a specific revenue ruling on the form, which is why you should probably— it gets more complicated if you're retroactively doing it. If you're just going to do a normal 2553 SCorp election, fill out the form, super simple. I think it's 2 pages, sign it twice, send it into the IRS, you wait for your acceptance. If you're going to do a retroactive SCorp election, you need to file it with a revenue ruling, an IRS revenue ruling. So that's when I would recommend getting a tax professional to help you with the form.
Okay, thank you.
All right. Any other questions?
All right. Thank you so much, Bobby. This was really, really helpful and informational. So, and it's
All right.
perfect time of year. for it. So
Hopefully,
we
hopefully
really
people got
appreciate it.
some value out of it. And if you guys have any questions, I'm happy to help. We have some, I'm going to post, I'll give you guys this so you could look at what I have in here and you can keep it. And if you want to get in touch with us, we have a special deal with Keller Williams and your guys' office. I offer a free 30-minute consult. So you'll get me personally. I'll be able to sit down and answer any questions you've got about your situation. This link right here is where you can schedule a time on my calendar. And we also have for Breadify, we have a special deal with Keller Williams where you guys get a discounted membership rate for the first year. So if these are things that you're interested in, or if you'd like to learn more, let me know. Feel free to schedule a time on my calendar. I'd love to talk to you and help you save a bunch of money on taxes.
Awesome. And if you send us those slides, then we'll be able to distribute it or send it to Mike or whoever's easiest, and we can get it out to everyone.
Absolutely. I really appreciate it.
All right. Thanks, everyone. Have a great day. Thanks, Bobby.
All right. Have a good one.